Mark is 38 years old. He drives a 14-year-old Camry. For the past decade and a half, he has saved $1,500 every single month without missing once. No exceptions, no excuses, just discipline compounding quietly in the background. Last March, something shifted. His index fund generated more income in 30 days than his actual job did. He did not get a raise. He did not sell anything. He just checked his account on a Tuesday morning and realized the engine had changed. Here is what most people assume about crossing $1 million, that it is the finish line. That is where the scoreboard stops, and the reward begins. That is not what the data shows. $1 million is not a destination. It is a structural threshold, a point where the underlying math of money stops working the way it did before and starts working in a direction most people never prepared for. So the real question is not how to get there. It is what actually changes when you do, and why so few people who cross it ever fully understand what they just stepped into. That gap between what people expect $1 million to mean and what it actually does mechanically, that is what this video is about. If you do not understand the shift, you can cross the threshold and still manage the money as if you are on the other side of it. The math keeps moving. You just stop benefiting from it. My name is Alex, and if you have ever looked at your savings rate and thought the numbers should be working harder by now, stay with this, because $1 million does not change your lifestyle. It changes the physics of your money. I am going to show you exactly where the tipping point is and why the rules of the game get replaced the moment you cross it. Once you understand what that threshold actually does, you will stop measuring your progress in dollars saved and start seeing the one number that actually tells you where you stand. The pattern that explains all of it traces back to one specific mathematical tipping point, and it has nothing to do with how hard you are working. Most people think compounding is something that happens gradually, a slow, steady climb, patient money doing patient work. And for the first stretch, that is exactly what it feels like. But at a specific point, and it is a specific point, not a vague zone, the behavior of compounding changes completely. It stops being gradual, it starts being structural. Here is what that actually looks like in numbers. Take 3 people. Rachel is a project manager in her mid-30s. She's been saving $1,500 a month for years, invests consistently in a broad index fund, and earns a 7% average annual return. She starts with $50,000. After 10 years of that same discipline, she ends up with around $260,000. That is real progress. 14 years of consistent behavior, compounding steadily, and she has built something solid. Now take Daniel. Same job, same market, same $1,500 a month. He started with $100,000 instead of $50,000. 10 years later, he is sitting at around $300,000. Better starting position, meaningfully better outcome. Still the same effort, still the same market. Then there is Mark. You already know his story. Same $1,500 a month, same 7% return, same 10-year window. But Mark started with $1 million. 10 years later, he is at $2.2 million. Pause on that for a second. Rachel put in the same monthly contribution as Mark. She worked just as hard, saved just as consistently. But Mark gained $1.2 million he never actually earned at his job. The market gave it to him, not because he was smarter or more disciplined, because he had enough capital. The compounding shifted from addition to multiplication. That is the tipping point, and it is not a metaphor. Below a certain threshold, compounding adds. Every month you contribute, the balance grows, and the growth is mostly a function of what you put in. Your savings rate is the engine. Your behavior is the variable that matters most. This is why the first stretch feels like pushing a boulder uphill, because it largely is. But above that threshold, something changes in the underlying math. The portfolio becomes large enough that its own internal return starts outpacing whatever you're adding manually. You are no longer the primary driver of your own wealth accumulation. The capital is. Your $1,500 a month becomes almost a rounding error compared to what the portfolio generates on its own. Now you are probably thinking, fine, but does the starting number really matter that much? Yes, more than almost any other variable. Currently, research consistently shows that the single biggest predictor of long-term portfolio growth is not the savings rate. It is the base from which compounding begins. The rate of return matters. The time horizon matters. But the starting capital, the mass behind the snowball, is what determines whether compounding adds or multiplies. Rachel will get there. Her discipline is real, and her trajectory is right, but she is still in the addition phase. Mark crossed into multiplication, and the gap between those two phases is not just financial, it is mechanical. The math behaves differently, not slightly differently, structurally differently. Getting the first million is a willpower game. The second million is a physics game. Those are not the same game, and they do not reward the same skills. Here is where it gets strange, though. The moment that multiplication kicks in, it does not just change how fast your money grows. It changes the income the portfolio generates. And at a specific number, that income crosses a threshold that most people never see coming. That is the crossover point, and it is worth understanding exactly what happens when it hits. There is a specific moment in every long-term investor's timeline that nobody really prepares you for. Not the day you hit a big number, not the day your portfolio recovers from a bad year. It is the day you realize your money is earning more than you are. That moment has a name. Wealth managers and financial planners call it the crossover point. And once you understand what it actually means mechanically, the whole picture shifts. Here is how to think about it. Say your take-home pay is around $70,000 a year. That is roughly the median household income in the United States right now. You work for it, you show up for it, you trade roughly 2,000 hours a year to receive it. Now, say your portfolio hits $1 million and returns 7%. That is $70,000 generated by capital alone. No commute, no performance review, no manager. The two numbers have crossed. Your money is now paying you a second salary, and it never clocks in. That is not a metaphor for freedom. That is a mechanical description of what is happening inside your balance sheet. Mark crossed that line last March. His portfolio did not just grow. It replaced the income argument entirely. The question stopped being how much I can save this month and became how long I can let this run. Those are fundamentally different questions. They require fundamentally different thinking. Now here is where the math gets genuinely interesting. There is a shortcut called the rule of 72. Divide 72 by your annual rate of return, and you get the number of years it takes your money to double. At 7%, that is roughly 10.3 years. Simple enough, but apply it forward from the crossover point and watch what happens. Mark hits $1 million at 38. By 48, that million has doubled to 2 million. By 58, it doubles again to 4 million. By 68, he is looking at $8 million. He contributed $1,500 a month the entire time. That monthly contribution, the thing that felt so significant in the early years, barely moved the needle compared to what compounding did on its own. Think about what that actually represents in human terms. Building that first million took Mark 14 years of real discipline. Consistent saving, consistent investing, no major mistakes. 14 years of delayed gratification. The next 7 million required none of that. It required patience, which sounds similar but is not the same thing at all. Discipline is active. Patience is structural. One costs you energy every month, the other just costs you time. And time at this stage is the only currency that actually matters. There is one more number worth knowing here. Research going back decades, and still referenced by financial planners currently, points to a 4% annual withdrawal rate as the threshold at which a portfolio sustains itself indefinitely. On $1 million, that is $40,000 a year, inflation adjusted, withdrawn every year without touching the underlying principle. You are not spending down the account. You are collecting the output while the machine keeps running. The goose stays alive. You just take the eggs. So the crossover point is not just an emotional milestone. It is a mechanical one. The income exists. The doubling sequence is already in motion. The withdrawal math already works. But here is what the crossover point does not tell you. The system that generates all of this return does not treat every dollar of income the same way. The hidden rules underneath, the tax structure, the inflation dynamic, the structural advantages that activate at this level, those are what most people never look at closely enough, and they change everything. Nobody hands you a rule book when your portfolio crosses $1 million. There is no orientation session, no welcome packet, no advisor who sits you down and says, here is how the system treats you differently now. You just cross the line and keep operating the way you always did, which is exactly why most people leave a significant amount of the advantage on the table without ever realizing it. There are 3 structural shifts that activate at this level. Not opinions, not strategies. Structural features of the American financial system work differently depending on which side of the threshold you are on. The first one is taxes. And this is where the system reveals something most working professionals never fully absorb. When you earn money through a paycheck, the federal government currently taxes your top bracket at 37%. You work, you get paid, and the government takes roughly a third before you see it. That is the wage tax. That is what labor costs in this system. But when your portfolio generates that same income through long-term capital gains, the top federal rate is 20%. Same dollar amount. Completely different treatment. Here's what that looks like on paper. Take two people. Both received $70,000 in investment income this year. Sandra is a teacher. She built her portfolio slowly, crossed the $1 million threshold last year, but still thinks about her investment income the way she thinks about her paycheck. She has not adjusted her tax approach. She ends up keeping around $56,000 after federal tax. James is an operations director who crossed the same threshold 2 years ago and restructured how his gains are realized. He pays long-term capital gains rates. He keeps around $58,000 on the same $70,000 of income. Same portfolio size, same return. James keeps an extra $2,000 every single year just by understanding which side of the tax structure he is operating on. Multiply that over a decade, and the difference is not trivial. The system is not hiding this. It is just not explained to you at the moment it starts to matter. The second shift is inflation, and it changes character entirely at this level. Below $1 million, inflation is a slow drain. It quietly erodes purchasing power, raises the cost of everything, and makes it harder to get ahead. You feel it mostly as a frustration. Currently, inflation is running around 3% annually on a $50,000 portfolio that costs you $1,500 in real purchasing power each year. That stings. On a $1 million portfolio, 3% inflation costs you $30,000. That sounds significantly worse. Until you run the other number. Your portfolio at a 7% annual return generates $70,000. You absorb the $30,000 inflation hit and still come out $40,000 ahead in real terms. Inflation went from being a headwind to being a line item you can absorb without changing your trajectory. Everyone else is running on a treadmill trying to keep pace. At this level, you are lapping them. The third shift is the withdrawal floor. Research that has been tested across 60 years of market cycles points to 4% as the sustainable annual withdrawal rate. On $1 million, that is $40,000 a year, inflation adjusted, drawn indefinitely without depleting the principal. The machine keeps running. You collect the output. That floor does not exist below the threshold. It only works because the base is large enough for the returns to sustain the withdrawal and still grow. 3 advantages, all structural, all invisible until you know to look for them. But knowing the advantages does not prepare you for what the dollar amounts actually feel like in real time, because here is what nobody warns you about. The same portfolio size that generates all of this structural security also means that a perfectly ordinary market move can erase $50,000 on a random Tuesday. And that creates a completely unexpected kind of pressure. That is the risk tolerance paradox, and it catches almost everyone off guard. Here's something that does not show up in any financial planning brochure. The feeling of having $1 million invested is not what most people expect. It is not calm. It is not reassuring, at least not at first. The structural security is real, but the daily experience of holding that much capital in a volatile market is genuinely unsettling in a way that smaller portfolios never were. And if you're not prepared for it, that feeling can push you into exactly the wrong decisions. Let me show you the math on this. When you have $50,000 invested and the market drops 5%, you lose $2,500. That is real money. It is frustrating, but it is also recoverable in a reasonable time frame, and it does not change your life in any immediate way. You check the account, you feel the sting, and you move on. When you have $1 million invested and the market drops that same 5%, you lose $50,000 in a single day, sometimes in a single afternoon. $50,000 is the median annual salary for a full-time worker in the United States currently. A completely routine market correction, the kind that happens several times every decade, can erase an entire year of someone's labor before the closing bell. You did not make a mistake. Nothing broke. The market just did what markets do. And you are down $50,000 by dinner. That shift in scale changes something psychological that is very difficult to anticipate until you are inside it. The percentage is identical. The emotional weight is not even close. Take David, a logistics manager who crossed the $1 million threshold at 41 after 18 years of disciplined saving. He understood markets intellectually. He had lived through corrections before and stayed the course. But 6 months after crossing the threshold, the market pulled back 11% over 5 weeks. His portfolio dropped $110,000. He watched it happen in real time, and for the first time in his investing life, he felt genuinely afraid, not of losing everything, just losing that specific number, that specific progress, the money he could see and almost touch. He did not panic sell, but he wanted to. And that want, that pull toward action, is exactly what the next section is about. Now here is the paradox. And it is worth slowing down for this, because it is the part that actually matters. Despite the larger dollar swings, despite the stomach-dropping volatility, despite the fact that a bad week now costs more in absolute terms than a bad year used to, the person with $1 million invested is structurally safer than they have ever been in their financial life. Not slightly safer, categorically safer. A job loss is no longer a crisis. It is a sabbatical. An unexpected medical bill does not threaten the household. A bad quarter at work does not change the long-term picture. The foundation underneath the volatility is deep enough that almost no single event, financial or personal, can collapse it. That security is real. It is just quiet. It does not announce itself the way the daily fluctuations do. So you end up in this strange position. You feel poorer on bad days than you ever did with $50,000 in the account, and you are safer than you have ever been in your life. Both of those things are true at the same time. The volatility is louder, the foundation is stronger, and learning to hold both of those realities simultaneously, without letting the noise override the structure, is the actual skill, which is exactly where most people fall apart, because the market does not beat them. Their own response to it does. And that is the wealth trap. And it has nothing to do with picking the wrong stocks. Most people who spend 15 years building $1 million assume the hard part is behind them. And in one sense, they are right. The accumulation phase is genuinely difficult. It requires consistency, sacrifice, and the ability to delay gratification for years at a stretch without any guarantee that the payoff is coming. Getting through that is a real achievement. The problem is that the skills that got you there are not the skills that keep you there. In fact, some of them become actively dangerous. This is the wealth trap. And it is not about bad investments or market timing or picking the wrong fund. It is about identity. Specifically, the identity of someone who built wealth through action, and what happens when action becomes the enemy. Think about what the accumulation phase actually rewards. It rewards hustle. It rewards optimization. It rewards the feeling that doing more, adjusting more, and staying on top of every variable produces better results. And for 14 years, that feeling was correct. Saving more worked. Cutting unnecessary expenses worked. Rebalancing at the right moments worked. The investor who stayed engaged, stayed sharp, stayed active, outperformed the one who checked out. Then you cross the threshold, and the game changes completely. At $1 million, the portfolio is large enough that its primary driver is no longer your behavior. It is time and compounding. Your job is no longer to optimize. Your job is not to interfere. Those are not even close to the same job description. This is where Rachel comes back into the picture. You met her in the first section. Project manager, mid-30s, disciplined saver, doing everything right. She hit $1 million at 41 after years of consistent investing. 18 months later, the market dropped 18% over 4 months. Not a crash, a correction. The kind that happens roughly every 3 to 4 years on average. Rachel did what every high-performing, detail-oriented professional does when something in their domain starts going wrong. She acted. She rebalanced aggressively, rotating out of equities and moving a significant portion into cash and short-term bonds to protect what she had built. It felt responsible. It felt like exactly the kind of active management that had served her well for years. She locked in $180,000 in realized losses. Then the market recovered. It took 14 months. She missed most of it because she was still sitting in cash, waiting for the right moment to get back in. The right moment never feels obvious when you're in the middle of it. 3 years after her portfolio hit $1 million, she was back where she had started. The market did not beat Rachel. Her own competence did. Charlie Munger, who built one of the most successful investment track records in American history, described the core discipline this way. The big money is not in the buying or the selling. It is in the waiting. That sounds passive. It is not. Waiting when every instinct is telling you to act, when the numbers are moving in the wrong direction, and the urge to do something is almost physical, is one of the hardest things a competent person can do. It goes against every professional reflex that made them successful in the first place. The discipline flip is real. The investor who crosses $1 million needs to retire a specific version of themselves. The optimizer, the adjuster, the one who got there by staying sharp and staying active. That version of you built the foundation. Letting it run is a different skill entirely, and it is one that most people never develop because nobody tells them it is required. The good news is that once you make that shift, once you actually internalize that your role has changed, what opens up on the other side is something most people spend their entire careers chasing without ever quite reaching it. People spend a lot of time thinking about what $1 million buys: the house upgrade, the early retirement, the financial security they have been picturing for years. And those things are real, but they are not actually what the threshold delivers. What $1 million really buys is something harder to quantify and far more valuable than any of those things. It buys the permanent ability to choose, not luxury, not leisure, choice. And that distinction matters more than most people realize until they are standing on the other side of it. Below $1 million, almost every major life decision runs through the same filter first. Not the cost of the thing itself, but the cost of being wrong. You stay in the job that is draining you because losing it would be a crisis. You do not negotiate too hard on salary because you cannot absorb the risk of the conversation going badly. You do not take the year off, start the business, or make the move to a different city because the financial margin underneath you is too thin to survive a mistake. Your choices are not free. They are tethered. Every decision has a floor it cannot fall through. Crossing the threshold does not remove risk. It changes what risk costs. Consider someone like Kevin. He is a mid-level marketing director, 43 years old, 14 years into a career at a company he has outgrown. He is good at his job. His performance reviews are strong. He is also miserable in a quiet, manageable way that he has learned to live with. For 6 years, he stayed because the math said to stay. He had a mortgage, 2 kids in school, and a savings buffer that covered 3 months of expenses if things went wrong. Leaving felt like a gamble he could not afford to lose. At 43, his portfolio crossed $1 million. He did not quit the next day, but something shifted in how he carried himself at work. He negotiated his next raise with a directness he had never allowed himself before. When his manager pushed back on a project he believed in, he pushed back harder. When a recruiter called about a role that paid less but aligned with work he actually wanted to do, he took the meeting instead of ignoring it. Not because he stopped caring about money, because the cost of a bad outcome was no longer catastrophic. The floor had changed. And when the floor changes, everything above it changes with it. That is what optionality actually means in practice. It is not a dramatic exit. It is a permanent shift in posture. The difference between making decisions from scarcity and making them from stability. Between tolerating a situation because you cannot afford to leave and staying because you have genuinely chosen to. Those two things can look identical from the outside. They feel completely different from the inside. Below the threshold, capital is defensive. It protects you from the immediate consequences of things going wrong. Above it, capital becomes offensive. It funds the version of your life you have been deferring, not someday, as a structural reality that already exists in your balance sheet, waiting for you to act on it. Mark drove a 14-year-old Camry when his portfolio crossed $1 million. He still drives it, not because he cannot afford something else, because he understands what the money is actually doing. It is not sitting there waiting to be spent. It is working. And the longer he leaves it alone, the more choices it quietly purchases on his behalf, which is why the real test of wealth was never how much you could accumulate. It was always how long you could leave it alone. Here's what this all comes down to. $1 million does not change your lifestyle. It changes the physics of your situation. The math that was working against you, slowly, quietly, persistently, starts working for you instead, not because you got smarter, because you got to the other side of a structural threshold that most people never fully understand, even after they cross it. A few things worth holding on to. Compounding does not just accelerate at scale. It changes character entirely. The tax system treats capital income and labor income as two different things, and the difference compounds just as everything else does. Volatility feels worse when the numbers are larger, but the foundation underneath it is deeper than it has ever been. And the discipline that builds the first million is not the discipline that protects it. Those are different skills, and confusing them is expensive. Watch for the moment your instinct tells you to act. That is usually the moment to stay still. The question this raises is worth sitting with. If crossing one threshold changes the mechanics this completely, what happens at the next one? What shifts between $1 million and 10 million that nobody is talking about either? If that question is already forming, you already know where this goes next.